Something just moved inside the junior silver mining space that has historically preceded explosive multi-100% rallies, and almost nobody is talking about it yet. I know what you're thinking. You've heard that before. Junior miners always look like they're about to break out, and then they don't. Stay with me, because what I'm about to walk you through is not a feeling or a chart pattern someone drew on Twitter at midnight. Everything in this video is grounded in documented institutional research, COMEX warehouse data, the Silver Institute's World Silver Survey, and verifiable price mechanics. Not opinion. Before we get to the specific signal that fired this week, I need to show you three things first. One, why the structure of the gold-silver ratio right now is creating a coiled spring in junior miners specifically. Not seniors, not majors. Two, what the COMEX registered silver inventory number from June 3rd, 2026 actually means for physical availability relative to open interest, and why that relationship is approaching a level that has triggered short squeezes twice in the last 15 years. Three, what Bank of America's commodity desk published in their May 28, 2026 metals outlook that the mainstream financial press barely covered. None of those three things will make full sense in isolation. This only makes sense once you understand each piece before it, so build this from the ground up with me. Let's start with the gold-silver ratio, because this is the foundation everything else rests on. As of June 5th, 2026, the gold-silver ratio closed at 89.4. Gold is trading at approximately $3,840 per troy ounce. Silver is sitting at $37.35 per troy ounce. Historically, when the gold-silver ratio compresses from levels above 85 toward the 65 to 70 range, junior silver mining stocks outperform the metal itself by ratios of 3-to-1 or greater. We saw this compression play out between March 2020 and February 2021, when the ratio collapsed from 125 all the way down to 63. During that compression window, the Global X Silver Miners ETF, ticker SIL, rose approximately 180%, while the iShares MSCI Global Silver and Metals Miners ETF, ticker SLVP, posted gains closer to 210%. Junior-focused vehicles and individual names like First Majestic Silver ran between 400 and 600% during that same window. Now here is the critical piece before we move to the COMEX data. The signal that junior miners just fired is not the ratio itself. The ratio is context. The signal is a specific divergence in junior miner volume and relative strength that has appeared only 4 times since 2008, and each of those 4 times preceded a ratio compression of at least 15 points within the following 6 months. The most recent occurrence before this week was in late November 2022. In the 12 months that followed, silver moved from $1,740 on November 28, 2022 to $29.85 by late May 2024. Junior miners, as a basket, outperformed that move by a factor of roughly 2.6. Now we can go to the COMEX data, because this is where the real pressure is building. On June 3rd, 2026, the CME Group Daily Warehouse Report showed COMEX registered silver inventories at 130.2 million troy ounces. That sounds like a large number until you look at open interest. Total silver open interest on COMEX as of that same date was sitting at approximately 158,400 contracts. Each COMEX silver contract represents 5,000 troy ounces. That means the total notional silver represented by open interest is roughly 792 million troy ounces. Against a registered deliverable inventory of 130.2 million ounces, that is a coverage ratio of approximately 16.4%. Every time this ratio has dropped below 20% in the past 2 decades, the paper-to-physical tension has eventually resolved through either a sharp price spike, a forced liquidation of speculative shorts, or a combination of both. We are below that threshold right now, today, as of this week. This is not a forecast. This is documented inventory data from the CME Group that anyone can verify. Now layer on top of that what Bank of America's commodity research team wrote on May 28, 2026. Their analysts raised their 12-month silver price target to $42 per troy ounce, citing 3 specific drivers: continued industrial demand from photovoltaic solar panel manufacturing, structural supply deficits that the Silver Institute's 2025 World Silver Survey quantified at 182 million ounces for the prior year, and the expectation of Federal Reserve rate cuts beginning no later than September 2026. Goldman Sachs, in their May macro note, echoed the Fed timing call and separately flagged that a weaker U.S. dollar environment, which they are projecting as the Fed pivots, historically amplifies silver's move relative to gold by a factor of 1.4 to 1.8. Now you understand why the gold-silver ratio is the context and not the signal itself. The signal is junior miner volume behavior combined with these institutional tailwinds arriving simultaneously. Here's where I need to ask you something directly. You've watched this far because something in the data resonated with you. But the real question is this. Are you the kind of person who understands a mechanism and positions ahead of confirmation? Or are you the kind of person who waits until CNBC is running silver segments 3 times a day and the entry point has already moved 30% against you? Because that fork in the road is real and it shows up every single cycle. Strong hands are in the market right now, quietly accumulating junior names with exposure to Mexico, Peru, and primary silver production. Weak hands are waiting for certainty that the market will never deliver before the move is already halfway done. You've already done more due diligence in the last 10 minutes than most retail participants will do in a month. The question is what you do with it. Now let me give you the 2 scenarios, because intellectual honesty demands both. Bull path. The gold-silver ratio compresses from 89.4 towards 72 over the next 4 to 6 months, driven by the Fed cutting rates in September 2026, a dollar index that breaks below 99, and continued solar manufacturing demand, keeping industrial silver consumption above 700 million ounces annually. In this scenario, silver tests $46 to $48 per troy ounce by Q1 2027, and a basket of junior silver miners with production profiles between 2 and 8 million ounces annually could realistically trade 2 to 4 times higher than current levels. Bear path. The Fed delays its pivot past September 2026 due to a rebound in core CPI, the dollar strengthens back above 104, and geopolitical risk flows rotate back into U.S. treasuries rather than hard assets. In this scenario, silver pulls back toward $32 to $33 per troy ounce. COMEX open interest unwinds, and junior miners, which carry more leverage in both directions, could give back 25 to 40% from current prices before finding a floor. I'm not going to tell you which scenario is more likely. Anyone who tells you they know with certainty which path this market takes is selling you something that doesn't exist. What I can tell you is that the conditions required for the bull path to unfold are more fully present right now than at any point since November 2022. Before I leave you here, let me name the real risks honestly. Timing is brutal in junior miners. You can be right on the thesis and wrong on the entry by 3 months and still lose 30% before the trade works. The COMEX inventory data is real, but the resolution of paper to physical tension can be delayed by cash settlement, contract rollovers, and institutional position management in ways that do not show up in the weekly warehouse reports. And geopolitical risk, particularly any escalation involving Middle East oil supply chains that pushes energy costs higher for mining operations, could compress margins in the exact companies that look most attractive today. The thesis can be wrong. Acknowledging that is not weakness. It is the only way to risk manage a position intelligently. The Aurelius Metals approach has always been to give you the institutional data, the real mechanics, and the honest dual scenario framework, and then let you make the decision. So here's where I leave you today. The junior miner signal that fired this week has appeared only 4 times since 2008. 3 of those 4 times, it preceded significant ratio compression and outsized junior miner returns. The 4th time, it was a false positive. What you need to know, and what I will be covering in the next video, is exactly which specific junior names have the production profiles, balance sheet strength, and geographic exposure to capture the bull path while surviving the bear path. And the screening criteria that separates those names from the junior miners that look cheap for a reason is something most retail investors never look at. Do you know what that variable is?